Okay, hi everyone. Let's work through this straight line amortization of bond discount and bond premium problem, which is problem 10-2A, though we're only going to focus on the amortization of the discount. Okay, reading right near my mouse here, it says that Hillside issued $4 million of 6% 15-year bonds dated January 1st, 2007 that pay interest semi-annually on June 30th and December 31st. Okay, now assume that the bonds were issued at a price of $3,456,448. That's this number right above my mouse. And then we need to prepare the journal entry, and I've got that shown right here. Okay, we record bonds at the face value, $4 million. The cash proceeds were the amount at which we issued the bonds for, the 3,456,448. So that goes right there. Therefore, the difference between $4 million and the cash proceeds of 3,456,448 has to show up as a debit in order for the entry to balance, and it shows up as a discount on bonds payable. Okay, now one thing to realize is if we have a discount on bonds payable, then that means we've issued the bonds at a market price that's higher than the stated value. So just because we know the bonds issued at a discount, we know the 6% stated value isn't what they were issued at. The market rate at the time was higher. Okay, with that in mind, Part B says for each semi-annual period, compute the cash payment, the straight line amortization, and the bond interest expense. And I'm going to show you how we do that. First, the cash payment. Okay, now what I've done is I've just slid over so that I've got a little bit of room to work next to the graphics I've added here. Okay, the bond face value is $4 million and the contract rate is 6%, and that's given in the problem. Okay, now the semi-annual payment, if we take the bond face value and multiply it times the contract rate and divide it by 2, and the reason why we have to divide it by 2 is that the semi-annual payment is given twice a year. Contract rate is stated on an annual basis. So essentially, we're multiplying the 4 million by 3% or multiplying the 4 million by 6% divided by 2. Either way, we come up with an answer of 120,000. Okay, now I've slid back over now, and that's how we come up with the 120,000. The next item we need to calculate is the straight line discount amortization and the bond interest expense. Okay, now I've slid the screen back over again, and off to the right, I'm going to show you how we come up with that $18,118 straight line bond discount amortization and bond interest expense. I've jotted down the discount on the bonds payable was $543,552. That came from right here, the difference between the face value of the bonds and the cash proceeds we received. Then we multiply that discount times the number of periods, and the number of periods are 15 years times 2 periods per year. Semi-annual means we pay it twice per year. Okay, once I do that, if I divide it, what I come up with is the amortization each period using the straight line method. So we're going to write off from the balance sheet $18,118 of that discount every period, and by the end, the discount on bonds payable will go to 0. Okay, let me slide on back and we'll cover the next calculation. Or actually, we don't need to. You see it right here. Let me read it to you because it's off the screen. It says, determine the total bond interest expense to be recognized over the bond life. Okay, and that dollar amount is $4,143,552. All right, now I know you only see part of that, but it does say determine the bond interest expense to be recognized over the bond's life. All right, so let's bring some things to light and see what we can come up with. The bond interest expense is $138,118. Well, how did we come up with that? Okay, here's how. Looking over here, let me slide this back again. I think I'm going to need to explain this a little bit. Okay, now we've slid back. The cash payment was $120,000, which we calculated earlier. The straight line discount amortization was $18,118. With a discount, we have to add the amortization to the cash payment, which increases interest expense. So adding those two, we come up with the $138,118. And then if you wanted to determine how much bond interest expense you would record using the straight line method, you take the bond interest expense for one period, okay, and then multiply it by the number of periods. And what you come up with is 4,143,540, which is just off slightly due to rounding. Okay, so just a rounding difference and we're off. Okay, now the screen probably jumped a little bit there on you. All right, now on Part D, we're going to use the straight line method to amortize the discount of these bonds, like the one shown in Exhibit 10.7, but I'm going to use my own method here. And we come up with these answers to come up what was the unamortized discount and what was the carrying value. And I'm going to slide over and show you how I work that. Okay, now I've slid over here, and here's my little schedule. We always had a face amount of $4 million, and I've just listed it in every period to make it easy. And we're going to show the straight line method for the first, 5 periods, the point we issue the bond, and then 6 months later, 6 months after that, 6 months after that, and 6 months after that. Okay, so we started off with $4 million. There's nothing amortized at the start of this. The unamortized discount was the $543,552, which we already had figured out earlier. So the carrying value then is going to be equal to $4 million less the unamortized discount. Okay, then when we go into the next period, we know we're going to amortize $18,118, which we calculated here. So to calculate the unamortized discount, you take the balance of the discount account from the previous period and you subtract out the amount you're amortizing. When we do that, we get a decreasing discount balance, and then the bond carrying value is the face value less the discount. So you see that the bond carrying value will increase over time. Once we have that, we can simply copy that formula down, and we get the exact same thing again. Same bond amortization, the discount, previous period less the $18,000. Since the discount is going down, the carrying value of the bond, which is always equal to the face value less whatever was unamortized on the balance sheet, right, goes up. And over time, it will approach the $4 million, become the $4 million in time for us to then pay back the bond. And that takes care of Part D. Okay, now I've slid back over so we can look at Part E, which says prepare the journal entries. Okay. Well, the journal entries to record the first interest payments. From before, we determined that the bond interest expense was going to be $138,118, and that was the sum of the payment plus the $18,118 of discount. So $120,000 plus the $18,118 of the straight line amount of the discount. And we credit the discount on bonds payable. Remember that the discount starts off as a contra bonds payable account. So it starts off as a debit. Reducing it results when we show a credit, and the cash amount of the payment is $120,000, so we're in balance. And then we make the exact same entry for the next every 6 months for the next 15 years until we pay off the bond. And when we do that, or pay down the discount, and then at the end we can pay off the bond, and the discount will have been amortized completely off the books, so that when we make that final payment, all we have to do then is credit cash and debit bonds payable for $4 million. And we pay back the face amount of the bonds. And that's this problem, everyone, covering through the discount portion. Thank you.